As the lights of New York dimmed at the end of the 1920s, the rest of the world had no idea it was about to plunge into darkness. It all started with the crash of the American financial market in late 1929. The world economy was a house of cards sustained by short-term capital. The flow of dollars to Europe was abruptly cut off after the crash. Everything began with the collapse of companies in the late 20s. Unemployment skyrocketed, and consumption simply ceased to exist. Imagine waking up on a Monday to find that the factory where you worked for 12 years has simply closed. That is what millions experienced in 1930. We entered a spiral where prices would not stop falling. Trade between nations suffered an invisible blockade and became paralyzed. Prices of food and raw materials plummeted in global markets. The price of wheat fell by nearly half in less than a year. More than 1,300 banks closed their doors in the U.S. in 1930 alone. The system was fragmented, with tens of thousands of small institutions lacking backing. Giants like the Ford Motor Company reduced work to just 3 days a week. In the American countryside, nearly half the population still lived without sanitation. In Chicago, wage losses reached $2 million per day. Public aid in the same city did not cover even a minimal fraction of the losses. In the media sector, CBS grossed over $14 million before the end of 1931. Industrial production in the major powers fell between 25% and 30% by the end of 1930. Combined unemployment between the U.S. and Germany exceeded the 9 million mark. In the United Kingdom, the gold standard was abandoned in the early 1930s. London devalued the pound to try to sell more abroad. Meanwhile, in Paris, the government insisted on gold until the middle of the decade. This French stubbornness caused stagnation and loss of market share. In 1930, the United States Congress passed the Smoot-Hawley Tariff Act, raising tariffs on more than 20,000 imported products, according to official U.S. Senate records. This caused a drop of more than 70% in European exports to America. U.S. sales to Europe also plummeted by about 2/3. The European banking system saw half of its foreign reserves evaporate. When the pocket empties, common sense usually goes with it. Economic misery eroded political stability, turning hunger into fuel for radicalism and military expansion. The economic vacuum paved the way for extremist regimes and rearmament. Berlin depended entirely on capital coming from Washington. When the Americans pulled the money back, the German system melted down. The withdrawal of capital generated a systemic banking failure in Central Europe. Berlin lived under the weight of impossible-to-pay war debts. The passing of moderate German leaders left a power vacuum. Before the crisis, radicalism in Berlin barely reached 3% of the voting intentions. At the height of the crisis, unemployment in Germany reached about 6 million people. With hunger at the door, the government began to rule by emergency decrees. In a few months, support for extremists jumped to nearly 1 in 7 voters. Soon, 1 in 5 Germans already supported the party that promised order through force. In Rome, the state took control of almost everything produced. They created institutions to rebuild industry under government command. The Italian leader held command of nearly 10 ministries at the same time. The state merged with religion to consolidate absolute control. Almost the entire Italian population voted under the shadow of the regime. Italian production was entirely redirected for military purposes. Tokyo was the first major power to see the light at the end of the tunnel through currency devaluation. Without an economic way out, Tokyo invaded neighboring territories in search of natural resources. Japanese growth was accelerated and focused on territorial expansion. East Asia saw invasion movements begin as early as the start of the 1930s. The Kremlin remained isolated due to sanctions and a closed system. While the world shrank, Moscow grew through rigid industrial plans. Moscow watched it all in isolation, moving millions of people to the cities. Russian agriculture underwent forced and aggressive collectivization. Revolts in the Soviet countryside numbered in the thousands. The Red Army expanded its armored fleet to nearly 5,000 units. Films preaching peace were banned by state censorship orders. Military aggression became the only acceptable growth policy for cornered regimes. The the world discovered that financial collapse was the perfect fuel for war tanks. The decade ended with the sound of boots marching over borders that trade could no longer maintain. If history doesn't repeat itself, it certainly rhymes. The noise the markets are making now recalls the crash that preceded the worst financial collapse ever seen. Data from the Bureau of Labor Statistics show that in the last Great Depression, 1 in 4 workers lost their livelihood. According to historical data from the Federal Deposit Insurance Corporation, approximately 9,000 American banks failed between 1930 and 1933. According to the quarterly report on household debt and credit from the Federal Reserve Bank of New York, American household debt has exceeded $18 trillion. When I see this, I hardly think of charts. I think of the credit card paid in 12 installments at the supermarket. This value is greater than all the wealth produced by Europe and Latin America combined. The price thermometer for companies in the S&P 500 is operating at double its historical average. The indicator comparing the stock market to GDP has reached nearly double the national production. The market is so concentrated that just 10 companies are worth more than a third of the entire index. We are betting the entire economy on half a dozen giants. This has gone wrong before. In about a year and a half, the Fed raised the cost of money from 0 to over 5%. The curve that predicts recessions has been inverted for months, a maximum alert signal. The amount of money in circulation grew by about 40% during the health crisis period. The purchasing power of every dollar bill has shrunk by a quarter since the start of this decade. In the last 3 years, filling the grocery cart has become a quarter more expensive. A median home today costs more than $400,000 in the American market. In a 4-year interval, house prices rose by half their previous value. The cost to finance a home more than doubled in a short period. To buy that house, a family would need to earn more than $100,000 a year. The reality is that the average worker earns little more than half that amount. There is a gap of over $50,000 between what is earned and what is needed for housing. The ease of buying a property has reached its lowest level in about 4 decades. In the 80s, a couple with common jobs could finance a house. Today, even earning above average, many people still need to share rent. The average monthly rent already consumes more than $2,000 of a family's budget. Owning a new car today costs, on average, nearly $50,000. The monthly payment for a vehicle commits more than $700 of family income. Interest rates for these loans fluctuate between 7% and 14% per year. The savings people manage to keep has fallen to less than 4% of income. Approximately 3 out of 5 people would not have $1,000 for an emergency today. The real wealth of the middle class, excluding the house, is less than $15,000 per family. According to the Congressional Budget Office, Washington closed the last fiscal year with a hole of nearly $2 trillion. For the first time, interest payments on the debt exceeded defense spending in certain periods. Today, major institutions like the Fed monitor these signals to prevent history from repeating itself. History shows us that commercial isolation and protectionism come at a high cost for all nations. It took extreme measures and decades of reconstruction for the world to regain the industrial breath it had before the crisis. Today, the global economy again faces warning signs that cannot be ignored by investors. The chasm between the cost of living and real household income is a social pressure we have seen before. Understanding these cycles is more than historical curiosity. It is a tool for financial survival. I study these cycles because I don't want to be surprised again, and maybe you don't either. Protecting your wealth begins with understanding that stability can be fragile. Don't wait for the system to melt before seeking knowledge and diversifying your strategies. If you want to understand how to prepare for the next market changes, subscribe to the channel and follow our weekly analyses. Share this video with those who need to understand that today's economy still rhymes with yesterday's lessons.